Hello, before we start today's video, just a quick note that if you are interested in purchasing this indicator, just simply email us at daytradinggps@gmail.com to request a discount promo code. In return for you taking your time for watching this video today, you can email us and request a discount promo code that will give you a substantial discount on the purchase of the indicator. All of our indicators are sold on a one payment for lifetime access basis. Thank you. One more thing before we get started, you'll see in the description of the video there will be this section here, which is click on this link for descriptions links to the other videos mentioned in this preview on different topics about the SPX indicator. So this is a Google Drive link. I'll show you where it takes you to now. So when you click on that link for the Google Drive, this is where it takes you to, which as you'll see is a list of different topics and links to the videos on the specific topics. These topics go into more detail. We may reference some of these topics very briefly in today's video, but when we reference to go look at the video that provides more details, then you'll just simply click on this link and go to here, and then you'll be able to click on the link that you want to see a more detailed video on a certain topic. Thank you. Hello, in today's video we'll be taking a look at the Wednesday, November 12, 2025 trading session for the CBOE SPX index. We'll be utilizing the Day Trading GPS SPX Daily Key Levels indicator for our trade entries and managing our trades. Specifically, we'll be using the newest version of this indicator, the V2.0 version, which was just released a few weeks ago. Okay, so some of you may already be familiar with how this indicator works from seeing our other recent SPX videos, but for those who are not familiar with how this indicator works, I will first run through how the indicator works before we get into today's trades. Okay, so this indicator works on the TradingView platform, and it works specifically on two SPX symbols. So the first symbol that it works on is the SPX symbol, which on TradingView you'd simply type in SPX and then you look for the SPX symbol that is under the CBOE exchange, and that is the main SPX official index that everyone follows. The other symbol that the indicator works on is the SPX 500 8-cap symbol. Okay, so here's a chart of that symbol. So on TradingView, you'd simply type in SPX 500, and then under SPX 500, you would look under that symbol search for, in TradingView, for the SPX 500 symbol under the 8-cap exchange. This is a Forex CFD symbol. And for those of you who are trading SPX index options, you would use it on the other symbol, SPX CBOE. But for those of you who are trading SPX through a Forex broker, you would put it on this symbol, SPX 500 8-cap. Now there is another reason why, if you're trading CBOE SPX index options, that you would want to open up a second chart with the SPX 500 symbol. And that reason is for getting the levels for CBOE SPX 30 minutes before the 9:30 a.m. Eastern New York time open. CBOE SPX opens at 9:30 a.m. Eastern New York time, and it is closed during the pre-market and overnight session. Whereas the SPX 500 Forex CFD trades in the overnight as well as the pre-market. The way TradingView Pine Script coding works is that if you have an indicator which plots levels and it already knows what those levels are, but the time that it already knows what the levels are, the market is closed for the particular symbol you have your chart on, it cannot display the levels on that chart until the first tick of that market open. So in the case of CBOE SPX, it does not open until 9:30 a.m. Eastern New York time. However, while on this SPX 500 chart, if you have a second chart open, you can get the levels 30 minutes early for CBOE SPX via the second table that is displayed on the SPX 500 8-cap chart. So as you see here, we have a table for the SPX 500 4x CFD levels, which are the same levels displayed on the chart for this symbol. But then we have this additional table here, which is displayed the CBOE SPX levels. And these are the same levels that you'll see at the first tick of the 9:30 open at 9:30 a.m. Except in this case, while on this symbol, you can get the levels at 9 a.m. So on the opening of this 9 o'clock candle here, this is what the chart would look like for SPX 500 8-cap. So you'd have the second table here, and then you would have a 30-minute jump on the CBOE SPX, where you can take some time and do some of your own analysis based on these levels as far as some strategy and planning. So this allows you to get a 30-minute jump on the session if you're trading SPX index options. Some other reasons why you might want to have it on the SPX 500 chart is if you're trading SPX 500 through a Forex broker, or you're trading through a Forex-based trading challenge such as FTMO, Apex, or the 5%ers, or there's about 70 or 80 other ones of the most popular ones. Mainly they're Forex-based. And with the trading challenges companies, you pay a fee to take a trading challenge with the company, and if you make a certain amount of profit over a certain period of time, and you do not violate either the daily loss limit or total loss limit on the challenge account, then you can qualify for a funded account with those companies in which you can use their risk capital to trade on instead of your own. And then you are splitting your profits, with the majority of the profits going to you. Typically that's anywhere from 80 to 95%, depending on the company, and then the rest goes to the company for providing the risk capital. So if you're involved in one of those trading challenges, or if you trade through a Forex broker, then you would trade SPX via having the indicator on this particular chart. So now we'll go back to the main chart. Okay, so we're back on the CBOE SPX chart. So this is a chart you would use for trading SPX index options with this indicator. As you can see, we have the chart on a 2-minute time frame. That is the recommended time frame to use for the indicator's daily key levels trading strategy. The range of time frames that are recommended for this strategy are anywhere from the 1-minute chart time frame up to the 5-minute chart time frame, with the 2-minute chart time frame being the one that we utilize in all of our videos, because we have found that to be the best chart time frame to use out of the 1-minute to 5-minute range. However, if you prefer using a different chart time frame because you're using under indicators or for other reasons, as long as you're using between 1-minute and 5-minute for this particular strategy, that's fine. But just keep in mind that on all of our videos we always demonstrate the strategy with the 2-minute chart time frame, as we've found that provides the most consistent results. Okay, so at 9:30 a.m. Eastern New York time, on the first tick of the CBOE SPX index open, then you will get your daily key levels on the chart as you see here. So the main level that the indicator will give updated for the current session is going to be the SPX Bull Bear KPL, which stands for key price level. We'll also be referring to this level as the BBKPL throughout the video. So if you hear that, that's what we're referring to. Now you'll also see these other levels here: the SPX PMH, SPX PML, SPX YDH, SPX YDL, and SPX YDC. What those represent are the SPX pre-market high, pre-market low, yesterday's daily high, specifically the previous day's RTH session high, YDC, which is yesterday's daily close, which is the previous day's RTH session close, and YDL, which is yesterday's daily low, the previous day's RTH session low. The other main levels on this particular indicator, besides the bull bear KPL, are the R1 through R6 levels above the bull bear KPL and the S1 through S6 levels below the bull bear KPL. You can also see those levels here in this table. Now, the reason that we are drilled down to the R2 through S3 level here on the screen instead of showing all the way up to R6 and all the way down to S3, and that is because at the beginning of, say, 95% or so of the 250 to 255 average sessions there are for SPX in a trading year, you are primarily going to be focused on, in the opening minutes of the session, the SPX bull bear key price level, and then the price levels of R2 down to S2 or R3 down to S3. So instead of having all of the levels shown, you simply take your mouse cursor and you drag up and down on the price axis, and that will expand the levels down from the R6 to S6 down to the levels that you see here. So this is important from the aspect of being able to drill down and see these levels more clearly, and especially for at the beginning of the session. Should price begin to move outside of S2 or R2, then you can expand your screen to see the other levels as well. But typically it's best at the beginning of the session that you drill down to either R2 through S2 or R3 through S3 or a combination of those. Okay, so what exactly does the bull bear key price level mean? Well, that is after the indicator's various algorithms analyze recent SPX price action as well as overnight and pre-market price action and current market dynamics and current market volatility. The bull bear key price level is the most important level that the indicator derives from doing that analysis. And what this means is that it's for initial bias of the session. So that would mean bullish bias above and bearish bias below. But keep in mind that that bias is for the initial part of the session, and that you can take bullish and bearish trades off of any of the main key levels. So what are meant by the main key levels? The bull bear key price level is a main key level, the R1 through R6 levels are main key levels, and the S1 through S6 are main key levels. You'll also see these midpoint levels in between levels. These midpoint levels have different purposes. They're not meant to take trades from, so those levels that you would take either bullish or bearish trades from are going to be the bull bear KPL, R1, R2, R3, R4, R5, and R6, and then S1, S2, S3, S4, S5, and S6. The midpoint levels have different purposes, one of which is for standard stop losses for bullish and bearish trades, and the midpoint levels above and below each level are used for the standard stop losses for either bullish or bearish trades. Their second purpose is that they are also used to gauge continuing momentum of a trade in your favor. The third purpose is that they are also used as decision-making points after a regular trade has moved a specific amount of levels in your favor. So we'll be getting into that later on, where we describe the two different types of trades that you have with this indicator. One is a scalp only trade, and the other type of trade is what we term as a regular trade. The QL levels that you see are above and below each level. As you can see here, we only have 3 of the QL levels turned on. The QL levels are used for tight stop losses on either bullish or bearish trades depending on what level you're taking the trade from. So for example, on a bearish trade taken from the bull bear KPL level, the QL above that level is the tight stop loss for a bearish trade taken from the bull bear KPL level. Whereas the standard stop loss, as we mentioned earlier, is going to be the midpoint above the bull bear KPL, in this case the level you're taking the trade from. Conversely, if you were taking a bullish trade off the bull bear KPL, then your tight stop loss would be the QL below the BB KPL, and on a bullish trade from the bull bear KPL, your standard stop loss would be the first midpoint level below the bull bear KPL. And the same thing works that way off other levels. So for example, if you were taking a bullish trade off of S2, as we saw in today's session, then your tight stop loss would be the QL below S2, and then your standard stop loss would be the midpoint below S2. Okay. So in the user control panel, you can enable the midpoint levels and the QL levels above and below each level. However, on the startup of the indicator, right out of the box after you receive the indicator, the default display for this indicator will show the following levels: the bull bear KPL, the R1 through R6 levels, the S1 through S6 levels, the PMH, PML, YDH, YDC, and YDL levels, and then the first midpoint above the BBKPL, the first midpoint below the BBKPL, the QL above the BBKPL, and the QL below the BBKPL. All of these other levels that you see, these midpoint levels here, here, and here, were turned on manually by us. And then this QL below S2 was also turned on manually by us. However, in the user control panel, you can reset the default displays for whatever levels that you desire, that you prefer to have on the startup of the indicator. So if you prefer a different look and feel and a different set of levels to be displayed on the startup of the indicator, you can simply make those changes in the user control panel and then save that as your new default display. Also, the tables that you see here are independently controlled. So you can change the size of this table, for example, and you can also change the position of the table to different positions on the table. And you can do the same thing with this table here. You can control the size independently of this one, and you can also change the position independently of this one. You can also turn either one of these off or both of them off if you do not wish to have one or the other on the screen, or you don't wish to have either one on the screen. As far as the line labels that you see on the different price levels, those are all independently controlled by group. So for example, the bull bear KPL and the R1 through R6 and S1 through S6 are all the main levels group. The midpoints are all controlled as a group, and the QL levels are all controlled as a group. So you can change the size of the line labels as a group, and you can also change the offset, moving them more to the left or moving them more to the right as a group. As you can see here, I have the offset set the same for the QL levels, the midpoint levels, and the main levels, so they're all in a row. However, in the user control panel, you can independently control them as groups. Also, the PMH and PML as a group, the YDH, YDC, and YDL are also controlled as a group, and you can do the same with those. You can change the size of them. So for example, the main levels here are in the large text size, whereas the midpoint levels are in the normal text size and the QL levels are in the small text size. The PMH, PML, YDH, YDC, and YDL are all in the normal text size. However, you can independently control by group both the size of the line labels for each group, as well as I stated earlier, the offset. Okay, so now let's get into how the indicator works as far as trading. So like I said before, you can take bullish or bearish trades off of any of the main key levels. Again, that is the bull bear key price level as well as R1 through R6 or S1 through S6. It's just typically at the beginning of a session, the bull bear key price level is going to be the level that is most in play. However, as the session progresses, there will be bullish and bearish opportunities off of the other main R levels or main S levels depending on how the session is progressing. As in today's session, we saw a trade off of the bull bear key price level, but we also saw a trade off of the S2 level as an example, which we will get to later on in the video. There is a video specifically made about taking trades off of any of the main R or S levels, and that video also goes into the two different types of trade entries with this indicator, one being the standard trade entry and the other one being the more conservative trade entry, which takes additional confirmations. That video is part of the list of videos with descriptions that we went over in the preview to this video, and that the link to that particular Google document is found in the description of this video. So if you simply click on that link, that will take you to the descriptions and links to other videos. You will see a variety of different topics covered with those particular other videos, and then one of those is going to be taking trades off of the other main levels as well as the two different types of trade entries. And then we also show in that video examples of the two different types of trade entries, the standard and the more conservative one, which takes more confirmations, how to recognize each, and then we show bullish and bearish examples of each. Okay, so as you can see here, we have the 9:30 a.m. opening candle here of the session marked off here. And as you can see, this candle opened below the bull bear key price level, stayed contained below the bull bear key price level intra-candle, and then also closed below the bull bear key price level. So if taking the 9:30 a.m. candle trade, this is your bearish entry signal on this indicator for a trade taken from the bull bear key price level. Now, the most important aspect of this candle is that it closed below the bull bear key price level. What I mean by that is that this opening candle could have opened up here above the bull bear key price level, and then intrabar traveled and crossed below the bull bear KPL and closed somewhere below the bull bear KPL, and that would again be a bearish signal. Also, the candle could have opened below as it did today, traveled intrabar up, but then reversed, went back down, and then still closed below the bull bear key price level. And that again would be a bearish entry signal. With the most important aspect of all of those being where it is closing. Conversely, if the reverse had happened, this had opened above the bull bear key price level, stayed contained above the bull bear key price level, and closed above it, that would be a bullish entry signal for that 9:30 a.m. opening candle. And the same other scenarios as well work in reverse as I just described for this bearish scenario. So in a bullish scenario, it could open below, cross above, and close above. That would be a bullish entry signal as well, even though it opened below. The point being is that it closed above. So open above, stay above, and close above is bullish. Opening below, crossing above, and closing above is bullish. It could open above, cross below, and then move back up and close above. That is still a bullish entry signal. Now, in the link to the other videos that I talked about a few minutes ago, there is also a video in the descriptions and links about the topic of 9:30 a.m. candles to avoid taking a 9:30 a.m. candle trade on despite the candle opening, despite the candle closing above or below the BBKPL level. So in that video, we talk about within range and out of range. And there's also an accompanying PDF document to that video that there is a Google Drive link to as well. And in that document, it goes over in more detail what exactly is considered within range and out of range. So an out of range opening 9:30 a.m. candle simply means that where the candle is closing is out of range for taking a trade off of the bull bear key price level, whether it be a bullish trade or a bearish trade. So it's important to know, as far as using this indicator, if you're inclined to take the 9:30 a.m. candle trade normally, as what constitutes being out of range. Now those types of candles only occur maybe 5 to 10 times a year at the most, out of the 250 to 255 SPX trading sessions on average within a year. So it doesn't happen that often, but if you are inclined to take that trade, it is important for you to know then when you are not supposed to take that trade despite it closing above or below the bull bear key price level. Now in this particular session, I'm not going to go into all the details about what's considered in range and out of range. You can simply watch that video and also look at that particular document for more details on that. But this particular candle is within range, so it is a bearish entry signal. Now, the 9:30 a.m. opening candle trade is part of the daily key level strategy using this indicator. However, there is not a rule or obligation that says that you must take that 9:30 a.m. candle trade as part of the strategy. It is simply an optional part of the strategy because you have to make a determination on the 9:30 candle as to whether you want to take it or not take it. So if you don't take the 9:30 a.m. opening candle trade, you can still take a trade in the first few moments of the session on succeeding candles if they are still within range and still closing above or below the bull bear KPL, such as the case in this session here, where you see these succeeding candles starting to move back up, then sideways, and then back down. So all of these candles here are still within range and of taking a bearish trade because they are all closing below the bull bear KPL and they are all still within the range. This particular candle here is out of range, so that would be too late. The pro side of waiting is that you can possibly get a better price for the option that you're purchasing. In this case, we would be purchasing a put option since this is a bearish play, because you're going to pay less for the put as price moves up but still stays under the bull bear KPL. Now keep in mind that this doesn't always happen like this where you'll get a retrace move back up. Oftentimes in a situation like this where you have a bearish entry signal, price will continue. It might have a slight stutter step to the side but then continues down in a bearish trajectory. And conversely, the same thing can happen on bullish candles that close the 9:30 candle open closing above the bull bear KPL. The same thing in reverse can happen. So don't always depend on having this sort of scenario where you're going to be able to be getting a better price. So if price begins to move out of range and you miss this opening candle trade, and let's just say it started moving out of range right after that, then you would just reassess and perhaps take a trade off of another level depending on what price action is showing you. The same thing with the out of range opening candle. On an out of range opening 9:30 a.m. candle where you're avoiding it because it is out of range, you would do the same thing. You would not take the opening 9:30 a.m. candle trade, but you would instead reassess after that and then consider taking a trade off of another level. But all that is outlined in that PDF document and also gone over in that specific video that I referenced earlier. Okay, so let's just go through this. 9:30 a.m. opening candle opens below and most importantly closes below the BBKPL. Bearish entry signal if taking 9:30 a.m. opening candle trade as within acceptable range for 9:30 a.m. opening candle trade. Also had multiple opportunities on the next 4 candles afterwards to still in a bearish trade on BBKPL level as all still below BBKPL and still within acceptable range of the BBKPL level. Now, since we have a bearish trade here, whether you're taking it here or these candles over here, how do we decide what type of option? Well, it's obviously going to be a put option because it's a bearish entry signal. But what I specifically mean is which put strikes are we to use? So with this indicator, there's always going to be 3 different option strikes that you can use for your bullish or bearish trade, depending on what main level you're taking your bullish or bearish trade from. So for example, in today's particular trade, the trade level that we're trading from is the bull bear KPL. The price of the bull bear KPL today is 68.70.97. So the closest strike price to this in SPX options is the 68.70 strike. If you're not familiar with SPX options, SPX options trade in 5-point increments. So for example, 68.60, 68.65, 68.70, 68.75, 68.80, etc. So the standard play is an at-the-money option. In this case, obviously a put option because we have a bearish signal. The standard play with this indicator is the at-the-money option. So that would be the 68.70 put option. The price on the candle close of this 2-minute candle is $18.70. We're waiting for the candle to close to confirm whether it's going to close above or below. So if you tried to purchase this intra-candle, then you could run into a problem because what happens if it's down here intra-candle but then closes above? Then instead it would be a bullish entry signal. So you want to wait for the candle close to confirm whether this is going to be a bullish or bearish trade opportunity. In this case, it was a bearish trade opportunity, and then, as I said, the standard play is the at-the-money closest to the level we're taking the trade from, the 68.70 put. $18.70 is the price on the close. If you're not familiar with how options work, the way that you would figure out how much you're paying for one option is you multiply the cost of the option times 100. So in purchasing this one particular 68.70 0DTE put option, you would pay $1,870. As you take the price that you're paying, multiply it times 100, and that's the price you're paying. So if you were buying multiple options, let's say you wanted to buy 2 put options, then you're going to pay 2 times $1,870. If you were buying 5, then it'd be 5 times $1,870, or 10 times $1,870. Now, as I said, there's always 3 options that you can choose from off any bullish or bearish trade off of any main R or S level or the bull bear KPL. This is how you figure out with this particular indicator what are the 2 out of the money strikes that you could use. So right now we're just going to go over the out of the money strikes that we can use on this particular trade. We do have a video that goes over this for all of the main levels, and that video is also found in the link in descriptions from that Google Drive document I mentioned earlier if you'd like to take a look at that video. So on this particular trade, the level we're trading is the BBKPL level, and we also have a bearish trade. So in that case, we're looking down since it's a bearish trade, And your first out of the money option would be the strike closest to the first midpoint level below the bull bear KPL. In this case, that is this level, mid BBKPLS1, 6861.74. The closest SPX strike to this is the 6860 strike. The 6860 0DTE put option strike on the candle close was $13.50. Now what about the third option strike that you have? The third one would be the furthest out of the money one you can consider on this particular trade. So again, this is the level we're taking the trade from. It's a bearish trade. We're looking down, and you simply look one full level down to get the furthest out of the money strike that you can use on this bearish trade from this level. That is S1 6852.50. So in this particular instance, 6852.50 actually is the exact midpoint between the 6855 strike and the 6850 strike. Normally this does not occur, and it's clear which strike is closest because it'll either be closer to the 6855 strike or this price will be closer to the 6850 strike. However, in this case, in this particular session, it is exactly in the middle. So if you have this sort of situation, then how you determine the strike is you pick the strike that's closest to the level that you're trading. So in this case, the level that we're trading is the bull bear KPL. So the 6855 strike is going to be the closest to that. And the 6855 0DTE put option, the price on the candle close of this 9:30 a.m. opening candle was $11.50. Now, with this particular indicator, you can either use 0DTE options or 1DTE options. So if you watch our other videos, you can see that most of the time we are utilizing the 0DTE options. One is because they're less expensive than the 1DTE options, and the second reason is most of our trades we're taking trade entries either on the 9:30 a.m. opening candle, or we're taking trades typically in the morning part of the session. So in that part of the session, as long as you are closing out your trades either in the later part of the morning session or at lunchtime or the very earliest part of the afternoon session, then those are typically fine. However, the 1DTE options do offer you something for the additional money that you're paying. What they offer you with the 1DTE options is that your ability to stay in a trade longer throughout the afternoon session. What do I mean by that? Well, sometimes you'll have sessions where you will get a clear entry signal, but then the session turns out to be very compressed and you're not getting much movement, and what you're getting is a lot of chop. And if you're going to stay in that trade, what I mean by chop is that it's not hitting your stop loss, nor is it hitting at least the minimum scalp trade target. It is doing neither, and it's just basically trading sideways. And once lunchtime passes and we start getting into the afternoon session, the 0DTE options will start losing a good bit of their time value, whereas the 1DTE options will hold their time value throughout basically the entire session. Now they will start to lose some of their time value later on in the session, but not nearly as rapidly as the 0DTEs do once you start getting into, say, 130 to 233 and beyond. So you will see situations, if you have that sort of situation and you're not just closing out the trade due to non-movement and you're staying in the trade waiting for the big move to happen, then with the 0DTE options, the move is going to have to be a lot bigger later in the day to overcome the time decay versus the 1DTE options, which are retaining much more of their time value, can still profit substantially from even the moderate moves in your favor. So that's just one reason of the pro and cons to look at versus whether you want to use 1 DTE options with this indicator or 0 DTE. The main thing to keep in mind is that this indicator is for day trading only. So whether you're using 0 DTE or 1 DTE options as the vehicle to do that day trading with, in all cases you are going to be opening and closing your positions all in the same session, regardless of whether you're using 0 DTE or 1 DTE. So for that reason, that's why it does not make any sense to use anything more than 1 DTE. For example, you wouldn't want to use an option that expires 3 or 4 days from now, because then it's going to be substantially more expensive than the 1 DTEs. So you're going to be paying a lot more per option, and then it's not going to move as much because it has so much time value built in. And the third reason is because you are going to be closing that trade out in the same session. You're not going to be holding the trades overnight or into another session or several sessions, because this is a day trading indicator and you'll be opening and closing them all within the same session. So today is one of the sessions that we'll be taking a look at the 0 DTE options versus the 1 DTE options and following their progression throughout the session. We do have a couple of other videos on this topic as well, and if you would like to see those other videos where we have had other sessions where we did 1 DTE versus 0 DTE, such as we're doing today, you can email us at daytradinggps@gmail.com and we can send you the links to those sessions to view as well. Okay, so going back to the 1 DTEs, the at the money 68.70 on this candle close was 25.93. The first out of the money 68.60 on the candle close was 21.40, and then the furthest out of the money 68.55 when DTE was $18. So you can see the difference in prices here. We have 18 versus almost 26, 18.70 versus 25.93. So that's roughly a $6 or actually $7.23 difference. Here we have 13.50 versus 21.40. So that's nearly an $8 difference. And then here we have $11.50 versus $18. So that is basically $6.50 difference. So there is quite a difference in price between all these. So that's one thing to keep in mind when considering which one to use. Now, as I mentioned earlier, there are two different types of trades that you can take with this indicator. One is scalp only trades, and the other we term as regular trades. And here are the differences between the two. Scalp only trades are 100% closeout only when the trade reaches a one level move in your favor. What do we mean by a one level move in your favor? Well, we can see that here in this particular trade. On the 9:46 a.m. candle, the S1 was hit on this low wick touch of the S1 level. So how do we get a one level move? It's calculated from the level that you're taking the trade from. In this case, the bull bear KPL level. It's a bearish trade, so we look down one level, and one level from this level is the S1 level. So here we have the touch of that level here on the 9:46 a.m. candle on the low wick touch. Now, as you can see here, the next candle also touched it, but in this case, instead of backing off after a wick, it actually closed slightly below it, and then had this small wick below it as well. Now, as far as take profits, as you can see here on the touch of this level, there are brokers that have a feature in which you can make a condition on your take profits that the take profit is activated when the price of the underlying reaches a certain level. And there's two brokers that offer that feature that I know of, and one is Thinkorswim, which is now owned by Charles Schwab, and then the other is Interactive Brokers. And if you look at that Google Drive link again, which I've mentioned several times in the description of this video, that takes you to the Google document that has the different descriptions of other topics in videos and other topics. One of those is going to be a video on utilizing that particular feature in Thinkorswim, that you can not only place stop losses based on the price of the underlying but on options, but that you can also do take profits based on the price of the underlying. So it's basically the same feature, and you would just use that feature on your take profit order as opposed to your stop loss order. Now, before we go on further, let me go over the stop losses that you would use on this particular trade. As you can see, I have them marked off here. The standard stop loss on this bearish trade from the BBKPL level is the first midpoint above the BBKPL. That's this level here. The tight stop loss is the QL above BBKPL, as noted here. Now, regardless of whether you use an at-the-money option or an out-of-the-money option, you're still going to use the same stop losses regardless of which option you choose to use, because the stop losses on trade entries are based on levels, not the price of the option. Whereas when you are adjusting a trade that's moved in your favor, then we are switching from price level based stop losses to then the normal regular price based option stop losses, which we will get to in a few minutes. And those are the kind of stop losses that all brokers have, the price based ones. So just keep in mind, when using this indicator on your trade entries, you're going to have price levels as your initial entry stop loss. So you'll either need to utilize Thinkorswim or Interactive Brokers, as those are the two that we know about that offer that feature, or you need to ask your broker if they have that feature on options, and just specifically ask them if they offer stop losses on options that are based on the price of the underlying. Now, if they don't offer that, and you don't want to switch to Thinkorswim or to Interactive Brokers, if your broker doesn't offer that, you don't want to switch, then what you will need to do as far as your initial entry stop loss is watch the price action on the chart, and if price action touches or crosses your stop loss level, you'll just need to manually stop yourself out. Now, you can also set an alert through TradingView for a touch or cross of a level as well. So you could set an alert for your stop loss to go off. That way, if you happen to not be looking right at your screen when it happens, then you can either see or hear the alert through the TradingView alert, and then you'll know that you'll need to go and manually stop yourself out. Okay, so 9:46 a.m. candle, we have the one level move in our favor, and now we have 100% closeout. So scalp only trades are 100% closeout when it reaches a one level move in your favor. SPX Bull Bear KPL, the S1, is a one level move in our favor on this bearish trade. And it's 100% closeout only. There's no stop loss adjustments. There's no scaling out. Regardless of how many contracts you are trading, whether it's 1, 2, 3, 5, 10, 20, etc., scalps with this indicator are 100% closeout. So these prices are on the low wick touch of this level. The 6870 0DTE put, 2380. That's $510 profit per option. The 6860 0DTE put, 1780. That's $430 profit per option. The 68.55 0DTE put, $13.90, that's $240 profit per option. As far as the 1DTEs, the 68.70 1DTE was $30, that's $407 profit per option. The 68.60 1DTE is $25, that's $360 profit per option. The 68.55 1DTE was $23.17, and that returned the most profit so far out of the 1DTEs, returning $517 profit per option. Okay, so next we'll move on to the 10:34 a.m. candle where it hits the mid S1, S2 level. So this is an example of a regular trade target. Regular trades, once you have reached the minimum required 1.5 level move target for regular trade, then you have these options. Either 100% closeout of all your contracts, whether you're trading 1, 2, 3, 5, 10, 20, etc., or adjusting your stop loss on all contracts to break even, or break even plus a 10 to 15% PB, which stands for profit buffer. So at this point, if you're adjusting your stop loss and not closing out all of your contracts, then you would not use a level anymore. Now you're switching to just a price-based stop loss on your option. So in the case of, for example, this option, adjusting your stop loss to break even would now be adjusting your stop loss from the price level to now your stop loss is 1870. Or you can adjust it to break even plus a 10 to 15% profit buffer. So for example, 10% on 1870 is $1.87. However, you could just round it up to $2 as this is a range here. So this is meant to make it simple. So if you just do 10% and you just want to round up to $2, then it's very easy for you just to convert this to $20.70, which would be a little bit over 10%. And you could do the same thing with 15%. 15% of 18 is basically $2.70. You could just round it up to 3 and make it $21.70. And then the same thing with these other options. Break even is simply going to be the price you paid, whereas break even plus the profit buffer is just simply adding an additional amount on top of break even. Now with regular trades, you also have an additional option, and that is if you're trading multiple contracts. If trading multiple contracts can close out 70 to 90% of those contracts and then adjust the stop loss on the remaining runners that you want to keep to either break even or break even plus the profit buffer. So for example, if you were trading four contracts and you closed out 3 of them, once it hit this level here, then that would leave you with 1 contract. So closing out 3 out of 4 is 75%, and then that leaves you just 1 contract to continue to manage after that. If you had 5 contracts and you sold 4 of them, then that would be 80%. If you sold 10 and sold 7, that would be 70. Or if you had 10 and sold 9, that would be 90%. As far as the minimum, with 3 contracts, if you sold 2 of them, that would be 66.67%, which is close enough to the 70%. So the real issue would be if you're only trading 1 or 2 contracts. So if you're trading 2 contracts, you should still treat it like you're just trading 1. So either, if you're only trading 2 contracts, either on regular trades, you would either 100% close out or adjust your stop loss on the 2 contracts to break even, or break even plus 10 to 15% profit buffer. As really scaling out 50% is not really a good idea. It needs to be the majority of them, which is going to be 70 to 90% if you're going to go that route of scaling out. Okay, then you also have further options at each succeeding level move in your favor after the initial minimum required 1.5 level move. you then have the same options and decisions to make at each succeeding level that price continues to move in your favor. If you already adjusted your stop loss at the 1.50 level, then add additional profit buffer at each level move in your favor on any remaining contracts that you do not close out at each succeeding level move in your favor. Alright, and we will get to that in a second here when we do have a move to the next level in our favor. First, we'll go over the profits here on this minimum 1.5 level move for the regular trade. 68.70 at the money 0DTE put 29.10. That's 1,040 profit per option. 68.60 22.25. That's $875 profit per option. 68.55 19.15. That's $765 profit per option. The 1 DTEs, we have the 68.70 at 35.77, $984 profit per option. 68.60s, 29.40, that's $800 profit per option. And the 68.55, 27.40, $940 profit per option. So here on this candle here, it hits S2. So on regular trade, this is the minimum ideal 2-level move for a regular trade. As you can see here, this candle not only touches it, but crosses slightly below it and closes below it. Now, what do we mean by minimum ideal 2-level move versus the minimum required 1.5 level move for a regular trade? Well, what a minimum ideal 2-level move means is that on volatility days, on days in which we have low to normal volatility, a 2-level move in your favor is on SPX is typically going to be the full extent of the move. Now, that doesn't mean that price can't continue to move in your favor and that volatility can't pick up and that the session can turn out to be a lot different even if it starts out with low to normal volatility, because I'm sure that a lot of you have seen sessions like that, or all of a sudden in the middle of a session, for one reason or another, either for technical reasons or for news reasons or whatever, all of a sudden price starts either going way up or plummeting. So you never know for sure whether it's going to continue to move in your favor or not. However, in most of the low to normal volatility sessions, the 2-level move is typically going to be the sweet spot for closing out all of your trades, and that is why it's considered the ideal level move. And that's clarified by ideal level move in a low to normal volatility session. And if we're in a high volatility market environment, then you're going to see more of the 3, 4, 5 level moves being the norm in a high volatility market. And then in extreme volatility markets, you're going to see 5 level, 6 level, and above moves. Now with this particular indicator, the V2.0 version, this indicator also has levels 7 through 10. So it also includes levels R7 through R10 and levels S7 through S10. The reason why those are not turned on by default is because the type of market environment that you would need to have those additional levels in does not occur that often. However, if it does occur, you do have them and you can enable them in the user control panel. Now, there are periods of time where the market has experienced extreme volatility for continuing periods of time and not just the odd day here or there. And as an example, that would be if you think back to the COVID pandemic days. And those particular times, we had weeks of extreme volatility where we would see 150, 200 point, even 300 point plus range days. And in those types of environments, you're going to see levels exceeding the S6 or R6. So if those types of volatility, extreme volatility environments return for whatever reason, then you can simply take advantage of them as well by simply turning on the S7 through S10 and R7 through R10 levels. Okay, so we have the 11:10 a.m. candle here, and these are the prices on the 11:10 a.m. candle close. 68.70 0DTE put, 39.67, that's $2,097 profit per option. The 68.60, 31.50, that's $1,800 profit per option. The 68.55 0DTE put, 27.60, that's $1,610 profit per option. And then that's versus the 1 DTEs. The 68.70 is 45.73, that's $1,980 profit per option. 68.60 is 38.27, that's $1,687 profit per option. And the furthest out of the money, 68.55 is 35.17, that's $1,717 profit per option. Now, as I stated earlier, if you already adjusted the stop loss at the 1.50 level move in your favor, then you would add additional profit buffer at each level move in your favor on any remaining contracts that you do not close out at each succeeding level move in your favor. So if you did adjust the stop loss here, let's say that you had either scaled out and you have remaining runners, or you adjusted your stop loss in all your contracts, then when it moves down to this level, you have all the same decisions to make again. Do I close out 100% of anything I have remaining, or do I adjust my stop loss? Of course, if you closed out all of your contracts here, then you're just free to consider other trades if you're going to continue trading at that level because you closed everything out. So what I'm talking about is if you had any remaining runners, or you just adjusted your stop loss and you're still in all your contracts. Okay, so now we get to an example of a trade off of another main R or S level, and in today's session that is the S2 level here, where we had multiple bullish trade opportunities. The first bullish trade opportunity occurred here on this 11:14 a.m. candle, which crossed above and closed above the S2 level. We also saw additional opportunity here after we had this cross and close above, and then also these succeeding candles here, which were also in range. Also, these succeeding candles here occurring here, 1, 2, 3, 4, 5 candles here, are all within the acceptable range as well. So if you did not enter on this candle, you could still enter on these candles as well. However, instead of going through every candle price scenario here, we're just going to pick two candles. So one is the initial one here, 11:14 p.m., and then this one here is an example of a reconfirmation trade at 11:54 a.m. candle here after we had this initial move up, a retest, and then a retest with a green candle closing above after coming close to retesting this S2 level again. So this is an example of additional confirmations here versus just a standard cross and close above. Now in this case, we're running out of room here for these comment boxes, which, by the way, these are simply comment boxes that we have manually placed on here, so it's easier to follow along with this video. Okay, so we have both of these candle prices here on the candle close. One is the 11:14, and then we have the 11:54. So on the 68.35, that is the at the money call closest to the S2 level. So as we said before, for a bullish or bearish trade entry, for the standard play, it is the at the money strike closest to the level that you're taking the trade from. In this case, 68.3404, This is a bullish trade, so 68.35 is the closing strike, 68.35 call option. Now we didn't do the at the money, or excuse me, the out of the money ones here, but I'll just run through it real quick. On a bullish trade from this level, your first out of the money option that you could consider would be the first midpoint above, 68.4327. The nearest strike to this is going to be the 68.45. So the 68.45 call would be your first out of the money strike. And then we look one level up, since this is a bullish trade from this level, 68.5250. However, in this case, this is still right in the middle, as we said earlier on this other trade when we were considering an out of the money in the other direction. So we do the same process here. So since this is a rare instance where it's exactly to the penny in the middle, then you are deferring, just like we said you're going to defer to this level when it was a bearish trade from this level, you're deferring to the level that you're taking the trade from in this case. So in this case, we would take out of the 68.55 or 68.50, we defer to the 68.50 because it's the closest to the level we're taking the trade from, since it's split right down the middle between the two strikes. So the at the money 68.35 call, the price on the 11:14 a.m. candle close is 15.30. The 1DTE 68.35 on the 11:14 a.m. candle close was 25.90. So that's quite a difference there, as you can see. Whereas on this candle entry here at 11:54, 40 minutes later, now the 68.35 0DTE call is 13.80. And whereas the 1DTE call is roughly the same price at 25.30. Now as far as tight and standard stop losses, this is the level we're taking the trade from, and it's a bullish trade, so our stop losses will be below this level. The tight stop loss is the QL level, QL below S2, so we simply turned on this level in the user control panel, and then we already have our mid S2, S3 level here, and that is the standard stop loss on this bullish trade from the S2 level. So tight stop loss on this bullish trade, standard stop loss. So in either case, neither one of those stop losses was coming close to getting breached. And as you can see here at 12:38 p.m. it hits S1 for our scalp trade. That's this candle here. This candle preceding it, the 12:36 candle, fell about 15 cents short of hitting 68.5250. So since it did not touch it then and fell short of it, that is not the candle, even though it may be hard for you to see that on your screen. That is the case. And the next candle hits the S1 level. And the 68.35 0DTE call in is now 23.20. So that's a profit of between 7.90 and 9.40 profit per option, depending on whether you bought it at 15.30 back on this candle or 13.80 on this candle. Whereas the 1DTE is 33.50, that's a profit of anywhere from 7.60 to 8.20 profit per option, depending on whether you bought it at 25.90 or 25.30. Now, as you can see here, we have the PML and YDH levels above. Now, one thing to keep in mind with this, as far as regular trades, if price had continued above here and actually touched this 1.5 level move, so this 1.5 level move here would be the mid BBKP LS1, so the level that we have the trade from, one level up and then a half level. So as you can see here, it fell short of that. But if, for example, it did hit that and we had the possibility of adjusting a trade and continuing on up here, then your next level at which you would have a decision to make at the succeeding level in your favor would be this level here, the bull bear KPL. And then the next level would be the PMH. Now, why would it be the PMH instead of this level as the next one? Because the PMH is occurring after the 1.5 level move threshold has been met for the regular trade. So it's in the direction after exceeding the 1.5 level threshold. So if you have any one of these levels, the PMH, PML, YDH, YDC, and YDCL levels, that happen to occur after the 1.5 level minimum move requirement has been met in a regular trade, those also are considered decision points, because oftentimes they can be reversal points for price action. So those also are additional decision points. Then the next decision point after that would be the mid BBKPL R1. Then after that R1. Then after that mid R1, R2. Then after that R2. Conversely, on this bearish trade here, had it continued down, then our next decision point would have been the mid S2, S3 level. And then our next one after that would be the YDL level, since it is occurring after the 1.5 level move in our favor. And then after YDL, it would be the S3 level. Okay, so that's going to conclude today's video. If you like this video, please do hit the like button, as it does help us with the YouTube algorithm. As we mentioned in the preview of today's video, if you do have an interest in purchasing this indicator, you can send us an email at daytradinggps@gmail.com to request a discount promo code to use on your purchase of this indicator. So for you taking your valuable time today to watch this video, you can request that promo code by sending us the email, and the promo code will be for a substantial discount off of the regular price of the indicator. All of our indicators are sold on a one payment for lifetime access basis. What that means is you make one payment and then you have access to the indicator for life. And that access for lifetime access also includes any additional versions that come out in the future that have additional or enhanced features. So, and that also includes any updates we may come out with in the future as well, on top of any versions. So, in the case of this particular indicator, there is another version of this indicator, the V3.0, that will be coming out very soon. It will have some substantial features added to it, and the price of this indicator will be going up substantially after the V3.0 is going to be released. But if you buy this indicator now, and you get the lifetime access, you can not only get it at the current price it's at now, with the promo code that you can get from emailing us, and then you will also get the V3.0 version when that comes out at no additional charge, and you will also have that for lifetime access. And then if we ever come out with additional versions after that or any other updates, then you will also get those as well. So if you'd like to get it at a better price, then I would encourage you to go ahead and get the indicator now, and then you will be entitled to receive the V3.0 indicator when it comes out soon, before the substantial price increase. So again, thank you for watching the video. If you'd like to see other videos, please subscribe to our channel. We do other videos on other trading topics as well periodically, and then you can also be advised if you are subscribing when we post any type of video on any trading topic, including new session videos on this indicator or any of our other indicators. So again, thank you for taking the time to watch our video today and supporting our channel, and we wish you much prosperity in all your future trading endeavors.